I want you to close your eyes for a second.
Yeah.
Visualize a moment that I think almost every single person listening has experienced at least once.
Mm-hmm.
You spent months planning a dream trip. You've survived the 10-hour flight. Your back is aching. You've eaten the questionable airplane pasta, and you stood in a customs line that, wraps around the entire building.
Oh, that line. The worst.
You finally step out into the arrivals hall. Let's say you're in London or maybe Tokyo, and the air smells different, the sounds are different. You are disoriented, you're jet-lagged, and you realize you need cash for a taxi.
The moment of truth. You are vulnerable, tired, and you just want to get to the hotel.
Exactly. So you see that brightly lit kiosk with the neon sign that says currency exchange? It looks official. It looks safe.
It's designed to.
It is. You pull up Google on your phone, you
Yeah.
check the rate, and you do a quick mental calculation. You think, okay, my $500 should get me about 450 euros. You walk up, you hand over your stack of hard-earned cash. The person behind the glass types a few things, counts out some colorful bills, and slides them back to you.
And that is when the sinking feeling sets in.
You look at the receipt, you look at the money in your hand, and you realize you didn't get 450 euros. You got 380.
Oof.
And you stand there blinking, looking at the clerk thinking, did I just get robbed? You do the math again, and you realize you just lost a massive chunk of your budget in like 30 seconds.
It's a universal travel trauma, that feeling that your money just evaporated into thin air. It feels like a scam.
It feels like magic, bad magic. But here's the thing. That frustration at the airport kiosk, that isn't just a tourist trap. That is the tiny, visible tip of the most massive, complex, and ruthless engine in the global economy. Today, we're doing a deep dive into exchange rates.
And I know hearing exchange rates might trigger flashbacks to a boring Economics 101 class. It sounds dry. It sounds like just numbers on a screen.
Yeah.
But when you peel back the layers, this isn't about math. This is about political power. It's about trade wars. It's about why governments rise and fall, and ultimately why your morning coffee costs what it costs.
We have a massive stack of research to get through today. Our mission is to move way, way beyond the numbers on a travel app. We're going to look at the machinery beneath the floorboards. We're talking about a market that trades over $5 trillion a single day.
A day. Yeah, to put that in perspective, that is significantly larger than the entire global stock market combined. The foreign exchange market is, it's the ocean that all other markets swim in.
So today we're going to connect the dots between interest rates, inflation, and why some governments might actually secretly or not so secretly conspire to make their own money worth less.
Which sounds completely counterintuitive. Why would you want your money to be worth less?
Yeah.
But it is a key part of the global strategy.
So let's start at ground zero. I need you to strip this down. What are we actually talking about when we say exchange rate? Because I think we use the term without really thinking about what it means physically or economically.
Right. At its absolute simplest, an exchange rate is a price. Just like a gallon of milk has a price in dollars, a currency has a price. But here is the twist, and this is what makes it unique. It is the price of one currency expressed in terms of another. It's just a ratio.
So it's relative. It's never just the dollar is strong. It has to be the dollar is strong compared to the yen.
Precisely. It's a seesaw. If the dollar goes up against the yen must go down against the dollar. You can't have both sides of the seesaw up at the same time.
Okay.
So if you see a quote, let's say USD JPY is 141, that is a price tag. It just tells you that the price of one single US dollar is 141 Japanese yen.
Okay, that part I get. That's the ratio. But let's go back to my airport disaster.
Yeah.
If the ratio is 141, why did the guy at the kiosk give me a rate that was so much worse? That's not a rounding error. That's a massive gap.
And this is where we have to make a crucial distinction that most people miss. We have to separate the retail market from the interbank market, what you saw on Google. That's the interbank rate. That is the real price, you could say.
That's the wholesale price.
Exactly. That is the price that Goldman Sachs, JP Morgan, and Deutsche Bank are charging each other when they swap $1 billion in a split second. The Bank for International Settlements values that market at roughly $5.3 trillion a day.
Wow.
It is incredibly liquid, incredibly efficient, and the spreads, the difference between buying and selling, are razor thin.
But I'm not Goldman Sachs. I'm just a guy in a Hawaiian shirt trying to buy a taxi ride.
And that puts you in the retail market. Think about the logistics of that kiosk. They aren't just moving digital numbers on a screen.
Right.
They have to rent that prime real estate in the airport, which is incredibly expensive. They have to pay for armored trucks to deliver physical cash. They have to pay for insurance, security cameras, and the person sitting behind the glass.
They have overhead. Lots of it.
Massive overhead, and the only way they cover that overhead is by marking up the product. It's the same as buying a can of Coke at a supermarket versus pitch it from the minibar in your hotel room. The liquid is the same, but the service of having it right there costs you.
So when I see those two columns on the board, the buy and the sell, that gap is their profit.
That is the bid-ask spread. And in a tourist location, that spread is enormous. The buy rate is what they are willing to pay you if you want to sell them euros. The sell rate is what they charge you if you want to buy euros.
And the real price, the Google price, is sitting right in the middle of those two numbers.
Exactly. So when you see a sign that says 0% commission, that is technically true. They aren't charging a separate fee on top. But they've baked a massive commission into the terrible rate they are offering you.
It's hidden in plain sight.
Right.
That is wildly frustrating, but I guess it makes sense as a business model.
It is. But here's where it gets really interesting. If you leave the airport and go to the professional world, the trading floors of London and New York, that spread, that profit margin has been getting tighter and tighter. It has become a war of efficiency.
What do you mean by a war?
Well, for decades, from the 1980s until about 2005, there was a standard convention in the market. Everyone quoted currency prices to 4 decimal places.
4 decimal places. So like 1.1234.
Right. And that 4th decimal place is called a pip. PIP, percentage and point. For a long time, that was the smallest unit of measurement. Traders would shout across the floor, "I'm up 10 pips," or "I'm down 20 pips."
It's like the sense of the currency world.
Exactly. But then technology started to take over. Electronic trading platforms began to replace the guys shouting on telephones. And in 2005, Barclays Capital did something that it disrupted the whole system. They broke convention.
What do they do?
They started quoting spot exchange rates on their electronic platform to 5 or even 6 decimal places.
5 decimal places. That seems excessively precise. Does the 5th decimal place of a penny even exist in the real world? Like, I can't pay for gum with a 5th decimal coin.
In the real world of buying a coffee, no. But in the world of high-frequency trading, it changed everything. Imagine you are a massive hedge fund. You weren't trading $100. You were trading $500 million.
Okay, so the volume magnifies everything.
Exactly. On a $500 million trade, a movement of 0.00001, that 5th decimal place, translates to thousands of dollars. By adding that extra decimal, Barclays was able to offer a slightly better price than their competitors. They undercut the market by a microscopic fraction.
It's the Walmart strategy. Slimmer margins, higher volume.
And it forced everyone else to follow suit. It tightened the spreads globally. It made the market more efficient for the big players. Barclays essentially started a technological arms race where algorithms fight over pipettes, fractions of a pip. Because when you sum it up over trillions of dollars, it's a fortune.
It really highlights the scale difference. At the kiosk, I'm worried about losing 20 bucks. In the interbank market, they are fighting wars over fractions of a penny because the stakes are in the billions.
That is the perfect way to frame it.
So we understand the price mechanism. We have the pips, the spreads, the wholesale versus retail. But the big question, the one that always confuses me, is who actually sets that baseline price? Is there a committee? Is there a guy in a basement at the Fed typing in numbers?
That brings us to the concept of exchange rate regimes. And the answer to who decides depends entirely on which country you are in and what point in history we are talking about. Broadly speaking, there are 2 camps, floating and fixed.
Okay, let's break those down. Floating is what we have in the U.S., right?
Yes. The U.S. dollar, the euro, the Japanese yen, the British pound, these are all floating currencies. In a floating regime, the price is determined purely by supply and demand in the open market.
So it's total chaos.
It's organized chaos. I mean, it changes constantly, 24 hours a day. Well, almost 24 hours. The market technically closes for the weekend.
Weekends off for the money markets.
Briefly. From about 20.15 GMT on Sunday until 22.0000 GMT Friday. But during the week, if more people want dollars, maybe to buy U.S. stocks or travel to New York, the dollar goes up. If people are selling dollars to buy euros, the dollar goes down. The government, for the most part, stays out of it. They let the market decide.
But that's not how everyone does it. You mentioned fixed or pegged rates.
Correct. Some countries look at that volatility, the bouncing up and down, and they say, no thanks. They choose to peg their currency. They tie their currency's value to another major currency, usually the U.S. dollar.
Give us a classic example of that.
The most famous historical example is China. From 1994 all the way to 2005, the The Chinese renminbi, or RMB, was pegged to the dollar at a rate of roughly 8.28.
8.28, it didn't change.
It was rock solid. It didn't matter what the market did. It didn't matter if there was a crisis or a boom. The Chinese government ensured that $1 always bought 8.28 RMB.
That seems rigid. Why would you do that? Why fight the market?
Stability. Imagine you are a factory owner in Shenzhen making toys for export. If the currency is floating, you don't know what your profit will be next month.
Right.
If the exchange rate moves against you, you could lose money. But with a peg, you know exactly what your money is worth. It allows for long-term planning.
It removes the risk.
It removes the currency risk, yes. But history teaches us a very harsh lesson. Maintaining a fixed rate is incredibly difficult. It requires massive resources. You are effectively trying to hold back the ocean.
Because if the market wants the price to change and you refuse, you have to fight the entire market.
Exactly. And this brings us to one of the most dramatic moments in economic history, the Nixon shock.
I love a good historical pivot point. Set the scene for us. This is the 70s.
We have to transport ourselves to August 1971. The situation was a pressure cooker. Before this, the entire Western world operated under the Bretton Woods system. It was a system of fixed exchange rates. Every major currency was pegged to the U.S. dollar, and the U.S. dollar was pegged to gold.
So money was real. It was backed by metal.
It was designed to be rock solid. $35 bought you an ounce of gold, period. But by 1971, the U.S. was in trouble. We were spending huge amounts on the Vietnam War and new social programs. Inflation was rising. And the world started to doubt that the U.S. actually had enough gold to back all the dollars in circulation.
So people started cashing out.
It was a run on the bank, but on a global scale. Countries like France and Switzerland started demanding gold in exchange for their dollars. The U.S. gold vaults were literally being drained. Speculators, they were often called the gnomes of Zurich, were betting heavily against the dollar.
So what did Nixon do?
He retreated to Camp David in total secrecy. Even his own State Department didn't know what was happening. It was a skeleton crew of economic advisors. They debated for an entire weekend. And then, on Sunday night, August 15th, Nixon interrupted the popular TV show Bonanza.
He interrupted Bonanza. That's how you know it's serious.
He went on television and dropped a bomb. He announced that he was closing the gold window. He ended the direct convertibility of the dollar to gold.
Brax stopped it.
He pulled the plug. By doing that, he blew up the entire fixed exchange rate system. The dollar was no longer tied to gold. It was floating.
It was an economic earthquake.
It was chaos. The Tokyo stock market crashed. Global trade essentially froze for weeks because nobody knew what a dollar was worth anymore. But Nixon admitted that the fixed system couldn't withstand the speculation. He pushed the world into the modern era.
So most of what we see today, these charts bouncing up and down every second, the apps on our phone, that is a post-1971 phenomenon.
Largely, yes. Although I should mention that some countries try a middle ground. We call them bands.
Bands, like a musical band.
Like a rubber band. Or, a better analogy might be bowling bumpers. A government might say, we will let the currency float, but only within this narrow range. If it goes too high or too low, if it hits the gutter, the central bank steps in and intervenes to push it back.
So it's a managed float.
Exactly. But as we've seen time and again, even bumpers can break if the ball is thrown hard enough.
So if we are in this floating world now, mostly, I want to understand the invisible hand. What actually moves the rate on a Tuesday afternoon? Why does the euro go up and the dollar go down? I assume it's not just random.
It's definitely not random. It comes down to supply and demand, but we need to identify the drivers of that supply and demand. You know, what motivates a billionaire in Singapore or a pension fund in London to buy or sell a currency? We can narrow it down to the big three key drivers: interest rates, inflation, and the balance of payments.
Okay, let's take them one by one. Interest rates. This is the one we hear about in the news constantly. The Fed raises rates and the dollar spikes. Why is that connection so strong?
Think like an investor. Imagine you manage a massive global fund, let's say $10 billion. Your job is to make that money grow. You want to put it in a savings account that pays the highest interest.
Right, I want the best yield.
So you look at the world map. If the U.S. raises its interest rates to 5% and Japan keeps their interest rates at 0%, where do you put your money?
I put it in the U.S., it's a no-brainer. I get a 5% return versus nothing.
Exactly. But here's the mechanism. To put your money in that U.S. bank account or buy that U.S. bond, you need U.S. dollars. You have to sell your yen or your euros and buy dollars.
And that buying pressure.
That huge demand for dollars drives the price of the dollar up. This is why higher interest rates act like a magnet for global capital. When the Fed raises rates, money sucks out of other countries and floods into the dollar.
That makes perfect sense. It's chasing yield.
Mm.
What about number two? Inflation.
Inflation is a bit trickier, but think of it this way. Inflation destroys the value of money. If a country has high inflation, the purchasing power of its bills is eroding. It buys less stuff.
Right. It's the melting ice cube.
Perfect analogy. If you are holding a currency that is melting, losing 10% or 20% of its value a year due to inflation, you want to get rid of it. You want to sell it and buy a currency that is stable.
So selling the inflationary currency drives its price down even further.
Precisely. So generally, countries with high inflation see their currencies depreciate against countries with low inflation. It's a vote of no confidence from the market.
And then the third factor is the balance of payments, or trade.
This is the real economy, imports and exports.
So cars, oil, wheat.
Yes. Let's say the U.S. buys a huge amount of electronics from Japan. To pay for those PlayStations and Toyotas, American importers have to sell dollars and buy yen.
Because Sony wants to get paid in yen, not dollars.
Exactly. So if the U.S. has a trade deficit, meaning it buys more from the world than it sells, it is constantly selling its own currency to pay for things.
It's flooding the world with dollars.
Which increases the supply and basic economics. When supply exceeds demand, the value goes down. So typically, a large trade deficit creates downward pressure on a currency.
But hold on. The U.S. has had a massive trade deficit for decades, and the dollar is still strong. So that rule doesn't always work.
And that brings us to the wild card, the factor that can overpower everything else, speculation.
The gamblers.
The strategic gamblers. Speculators aren't buying currency to buy goods. They aren't buying dollars to buy a Toyota. They are buying currency because they think the price will change. They are betting on the direction.
It's like betting on a horse race, but the betting actually influences the speed of the horse.
That is a brilliant way to put it. It can create a self-fulfilling prophecy. If huge hedge funds believe a currency will fall, they will short it. They sell it aggressively.
And that selling pressure
Forces the price down. It can actually overwhelm a country's central bank. If speculators attack a currency, the central bank has to spend its own reserves to buy its currency back to prop it up. It is a very costly battle.
It's like trying to catch a falling knife.
And often the speculators win. They have more money than the central bank has reserves. George Soros famously broke the Bank of England in 1992 doing exactly this. He bet the pound would fall, and he was right. Made $1 billion in a day, and the UK was forced to devalue.
That is terrifying. It's like the market can bully a sovereign nation.
It absolutely can. The bond vigilantes and the currency speculators are often more powerful than prime ministers.
So with all these moving parts, interest rates, trade, speculators, is there any way to know what the price should be? Is there a fair price for a dollar or a euro, or is it all just relativity?
The economists love to try and find that fair price. They hate chaos. The most famous concept for this is purchasing power parity, or PPP.
I've heard of this. This is the Big Mac Index idea, right?
Exactly. The Economist magazine popularized this. The idea is based on the law of one price. Theoretically, a Big Mac is the same product whether you buy it in New York, London, or Mumbai. Same bun, same meat, same lettuce.
What should cost the same?
Theoretically, yes. If a Big Mac costs $5 in the U.S. and the exchange rate with Europe is 1.1, it should cost 5.0 in Europe.
And if it doesn't?
Let's say the Big Mac costs 7.0 in Europe, that suggests the euro is overvalued, or the dollar is undervalued. The theory says the exchange rate should eventually adjust until the prices are equal.
But we know that doesn't always happen. A haircut in New York costs way more than a haircut in Hanoi, and the exchange rate doesn't magically fix it.
True. PPP has flaws. It doesn't account for taxes, labor costs, or goods that can't be shipped. You can't ship a haircut. But we use it to calculate the real exchange rate, or RER. This is the nominal rate adjusted for inflation. It measures true competitiveness.
Why does this real rate matter to anyone but an economist?
Because if the real exchange rate gets misaligned for too long, it is a flashing red light. It's like building up pressure in a fault line. If a currency is overvalued for a long time, it signals an upcoming earthquake.
Do we have a real-world example of that earthquake hitting?
Thailand, 1997, the Asian financial crisis. This is a textbook example of PPP coming back to haunt a country.
What happened?
Thailand had pegged its currency, the baht, to the U.S. dollar. They kept it stable. But their economy was different from the U.S. economy. Their inflation was higher. According to PPP, the baht should have been falling in value.
But the government forced it to stay high.
Exactly. They held the peg. This made Thai exports expensive and hurt their economy. Eventually, the discrepancy became too obvious. The real value was so far below the official value that speculators, the sharks, smelled blood.
They attacked.
They started selling the baht aggressively. The Thai government spent billions of dollars of their foreign reserves trying to buy the baht and keep the price up, but they ran out of ammo.
The GandM broke.
On July 2nd, 1997, they had to let the currency float. It crashed. It lost half its value almost overnight. Companies went bankrupt, the stock market collapsed, and the contagion spread across all of Asia.
So the real rate always wins in the end. You can't fight gravity forever.
Eventually, yes. But there is a modern twist that complicates this basket of goods theory. We have to talk about the asset market model.
What is that?
Well, the Big Mac Index focuses on trade goods and services. But today, the world has changed. The trading of financial assets, stocks, bonds, derivatives, it dwarfs the trading of physical goods.
Right. There's way more money moving in the stock market than in the supermarket.
Exactly. So the asset market model says that currencies behave more like asset prices, like stock prices, than just trade balancers.
So the dollar moves not because we sold more cars, but because investors want to buy U.S. tech stocks.
Yes. Think about it. If everyone in the world wants to buy NVIDIA or Apple or U.S. Treasury bonds, they need U.S. dollars to do it. That demand drives the dollar up, even if the U.S. is running a trade deficit on physical goods.
That explains the U.S. situation perfectly. We buy more stuff than we sell, but everyone wants to own U.S. assets, so the dollar stays strong.
Exactly. Money flows to where it is treated best and where the assets are most attractive. The financial economy has sort of overtaken the real economy as the driver of exchange rates.
Now, I want to pivot to the darker side of this. We talked about governments trying to stabilize their currency, but don't some countries actually manipulate it? I hear this term currency war thrown around.
This is a huge topic in international relations. We call it modern mercantilism.
Mercantilism sounds very 17th century, like sailing ships and spice trades.
It is old school. The old idea was to hoard gold. The modern version is to hoard export dominance. And the way you do that is by keeping your currency artificially cheap.
Explain that logic. Usually I want my things to be valuable. If I own a house, I want the price to go up. Why would a country want its money to be cheap?
The paradox of value. If my currency is cheap, my exports are cheaper for you to buy.
Give me an example.
Let's say I am Japan and I want to sell Toyotas to America. If the yen is weak, if it costs very few dollars to buy a lot of yen, then the price of that Toyota in dollars is low.
So Americans buy more Toyotas because they are a bargain.
Exactly. And that keeps the Japanese factories humming, it keeps employment high, and it boosts the Japanese economy. This is export-led growth.
So they are intentionally devaluing their money to undercut the competition.
Yes. It is a beggar thy neighbor policy. You are essentially stealing growth from other countries by making your goods artificially cheap.
But there has to be a trade-off. There's no free lunch.
The trade-off is painful for the local people. It helps exporters, but it hurts the consumers in that country.
Because now imports are expensive for them.
Exactly. If you live in a country with an artificially low currency, buying an iPhone or foreign oil or imported medicine becomes very expensive. You are effectively subsidizing the export industry with your own purchasing power. You are making your citizens poorer so your factories can stay busy.
Who are the big players who have done this?
China is the most frequently cited example. For years, they were accused of keeping the RMB undervalued to fuel that massive manufacturing boom that transformed their economy. But they aren't alone. Japan, Brazil, Iceland, many nations have used competitive devaluation as a tool.
And this causes tension.
Huge tension. When one country does it, others retaliate. They lower their rates too. It's a race to the bottom, and that can lead to trade wars, tariffs, and political instability.
Speaking of instability, what happens when a government tries to control the rate too strictly and the market simply refuses to play along? What happens when the people stop trusting the official price?
Then you get parallel markets or black markets.
The street rate.
Argentina is the textbook case study here. It is fascinating and tragic.
What is the situation there?
Argentina has a history of economic volatility. To stop money from fleeing the country, the government often imposes capital controls. They restrict how many dollars you can buy.
So if I'm in Buenos Aires, I can't just walk into a bank and get dollars.
Not at the official rate. The government might say the rate is 100 pesos to the dollar, but they won't sell you any dollars at that price. Or they limit you to, say, $200 a month.
But people don't trust the peso. They know inflation is eating it alive.
Exactly. They desperately want dollars to save their wealth. So a black market emerges. You have the official rate, which is a fantasy, and then you have the blue dollar.
Why do they call it the blue dollar?
It's likely a reference to the blue strip on the new $100 bills. You have people on the streets, they call them arbolitos or little trees, standing there whispering, cambio, cambio, exchange, exchange.
And the price there is different.
Drastically different. The parallel premium, the gap between the official rate and the street rate, can be 100% or more. The street rate is the real perception of value.
That's a vicious cycle.
It is. The government imposes controls to save the currency. The black market rises. The economy gets distorted because nobody knows what the real price is. Eventually, the gap becomes so ridiculous that the government has to lift controls, like President Macri did in 2015.
And what happened then?
The currency devalued massively to match the real market. It was painful, inflation spiked, and eventually controls had to be put back in. It's a constant struggle between political will and market reality.
It really shows that you can't just decree what money is worth. You can print the bills, but you can't force people to value them.
You can try, but the market, the collective wisdom and fear of millions of people, usually has the final say.
This has been a wild ride. We've gone from the fluorescent lights of the airport kiosk, to the high-speed servers of Barclays, to the secret meetings at Camp David with Nixon and the streets of Buenos Aires. It is a massive, interconnected system.
It is the nervous system of the global economy. Every shock, every fear, every hope is reflected in these rates.
We've seen how interest rates attract capital like a magnet. We've seen how inflation erodes value like a melting ice cube. And we've seen how trade deficits push supply.
And we've learned that sometimes the price on the screen isn't the real price, whether it's because of a retail markup or a government peg that is about to break.
Exchange rates aren't just numbers. They are a scorecard. They tell us about a country's economic health, its political stability, and its strategy in the global game.
And that strategy is constantly evolving.
Here is where I want to leave it, and this is something that stuck with me from the asset market model discussion. We are living in a world where financial trades dwarf physical trade. We aren't just trading wheat and steel anymore. We are trading debt, equity, and derivatives.
That is the crucial takeaway, the financialization of the world.
So if currencies are increasingly driven by stock market speculation, by algorithms fighting for pips rather than the price of milk and bread, have exchange rates decoupled from the real economy entirely?
That is the fear.
And if money is just another asset class for speculators, just chips in a global casino, what does that mean for the next financial crisis? When the next Thailand happens, will it be triggered by a bad harvest or by a sentiment shift in an algorithm?
That is the multi-trillion-dollar question. And as we saw in 2008 and in 1997, when the currency market breaks, everything else breaks with it.
Something to think about next time you're staring at that board in the airport trying to figure out if you can afford a taxi. Thanks for listening to The Deep Dive.
Thank you.